So let me begin by thanking Christian for inviting me here today, and thank all of you and the CFA Institute for coming. It's a pleasure and an honor for me to be here to tell you a little bit about this book that I've just published. Now, I have to start with a disclaimer, which is that, typically when I write a book, I try to keep it as short as possible, because readers' attention spans tend to be rather short, particularly nowadays with all of the social media and things like that. But my publisher warned me that when you write a book, every equation that you put in the book will reduce the number of readers by half. And as a result, this book has no equations whatsoever. And unfortunately, that means that it's 500 pages long. So I'm going to try to give you a bit of a brief overview of a few of the concepts that are most relevant to the financial community. And what I'd like to do is to start by talking about hedge funds, because that's obviously a very important part of the financial industry and something that Switzerland has been quite focused on for decades now, in many cases earlier than many other investors. So I want to start by asking the question, are hedge funds irrelevant? And the reason that I'm asking, of course, is because over the course of the last maybe 5 and certainly even as far back as 10 years before the financial crisis, the returns to hedge funds have become challenged. And we see that in a number of newspaper articles, we've questioned the relevance of hedge funds, even starting as far back as 2012. The Economist wrote, "Are hedge funds going nowhere fast?" 2013, on the other hand, hedge fund performance seems to have done better, so hedge funds storm back. But as of earlier this year, the industry is supposed to be in crisis. Money is leaving the hedge fund space for many other kinds of investments. Now, this kind of a cycle is not new. It's been happening for quite some time. For example, in 2002, hedge funds were considered an absolute disappointment. On the other hand, by 2005, newspapers were writing, "If I only had a hedge fund." And by the end of 2005, hedge funds were starting to make inroads in the retail or mutual fund space. So this kind of a cycle is actually not that new. As Mark Twain once wrote, "The news of my death is greatly exaggerated." I think the same thing can be said of the hedge fund industry. News of the hedge fund industry's death is greatly exaggerated. And one way to tell is by looking at its performance and its assets under management. So this is hedge fund index returns. And you can see that in the 1990s, hedge funds definitely performed better on average than over the course of the last 10 years. What about assets under management? Well, this is, according to the trade sources, the amount of assets that are managed in hedge funds. And while money goes in and out from quarter to quarter, over the course of several years, we see that hedge funds have been growing in assets under management. And if you look at funds of funds, that's been very challenged, but that's partly because of the fee structure and the performance net of fees of these funds of funds. But for managed futures, we see that that's been growing steadily as an example of how certain sectors of the hedge fund industry have been performing. So hedge fund assets are still there and getting larger, but performance has definitely been challenged. And one of the interesting things about this pattern is the underlying causes and dynamics of the hedge fund industry. So let me show you a little bit about what's been going on. Investors have this love-hate relationship with hedge funds, and part of the reason for that has to do with this dual nature of what they get from hedge funds and what they have to give up. So let me give you a little bit of an overview about what the challenges are, and then I'll turn to some interesting performance statistics. Investors love the diversification benefits of hedge funds. The fact that they offer unlimited potential in terms of performance because they're unconstrained, they allow for the use of leverage, and frankly, the sophistication and mystique surrounding hedge funds. That really draws investors in, as you all know. On the other hand, what do investors hate about hedge funds? Well, lack of transparency, lack of liquidity, limited capacity, high fees, operational risks, so on and so forth. And most recently, this idea that hedge funds offer beta disguised as alpha. And so there's this tension between the love-hate relationship that investors have. And what that illustrates, I think, is the dual nature of hedge fund performance, how difficult it is sometimes to separate out these kinds of issues. So a few years ago, I wrote a paper with some colleagues that looks at the overview of the hedge fund industry, titled Hedge Funds, A Dynamic Industry in Transition. And in this paper, we look at a performance comparison of hedge funds before and after the crisis. And I won't go through all of these numbers with you, there are many of them, but I just want to illustrate to you a very interesting trend and comparison between the pre and post-crisis period. So the pre-crisis period is January 1996 through December of 2006. And during that period, if you look at the bottom line performance of single manager hedge funds, and you look at the annual mean return, what you're getting is something on the order of about 8%, 8.7% on average, with a standard deviation of about 6.5%. So that's a pretty good average performance across all of the various different kinds of hedge funds in the sector. That was pre-crisis. Now, post-crisis, I don't know if you can see the numbers in the back, but I'll read to you the most relevant ones. Post-crisis, the average return of single manager hedge funds, 4.2%. Standard deviation, also about 4.2%. So what you're seeing is that after the crisis, the returns for single manager hedge funds has been cut in half. But now, if you take a look at the column on Sharpe ratios, you see something very different. The Sharpe ratio for single manager hedge funds before the crisis is 0.72. The Sharpe ratio for single manager hedge funds after the crisis, 1.0. Higher Sharpe ratio after the crisis. So what's going on? It seems very strange. People talk about hedge fund performance as being disappointing, and we see it is disappointing. The average return has been cut by half, but the Sharpe ratio has actually gone up. So what this tells us is that hedge fund managers have not lost their skill. They still are able to generate risk-adjusted returns that are more attractive, but a few things have happened post-crisis. One, leverage is down. Leverage is down because, well, we all know that banks have been required to reduce their leverage because of changes in capital requirements by regulators. Two, volatility is down. And without volatility, many of these strategies don't generate the traditional expected returns. And three, the risk-free rate of interest is down. And so for all three of these reasons, hedge fund absolute performance has declined. The risk-adjusted returns are still there. But because of the traditional factors that support hedge fund returns, the landscape has changed. We see that hedge fund performance has been disappointing. And you can see that if you take a look at the correlation to the S&P 500 of equity market neutral strategies, you can see one example of the changes in dynamics. Before the crisis, equity market neutral, by definition, if you're market neutral, that means you're long 100 and short 100. You should have very little correlation to the S&P. Before the crisis, the correlation of equity market neutral managers to the S&P 500, 3%. After the crisis, the correlation is 81.6%. Market neutral. A market neutral strategy has an 82% correlation with the S&P. A very different set of dynamics. And so really what we're seeing is the life cycle of hedge fund strategies. And here's one very, very complicated illustration of that. This is the most sophisticated diagram I have in my entire slide deck. A typical hedge fund strategy starts with unique alpha. Absolutely unique. Somebody who comes up with an idea, this person is the only person that has the idea, and the manager is able to generate unique investment returns based on that idea. The idea is so good that eventually people start copying the idea. And what starts out as unique is now novel, but no longer unique. Now you have two people doing the same thing, generating alpha of slightly different color, but now no longer unique. And now more people copy it because it's such a good idea that the alphas get smaller They have different colors, more people are doing it, and eventually, after this particular idea has been so copied and commoditized, what starts out as unique alpha ultimately becomes beta. Notice that beta has little alphas. It took me a long time to line this up, so I hope you enjoy that. This kind of a life cycle is what we see in the hedge fund industry, and it happens even within the course of a year. There are strategies. Some of my colleagues now that are in the high-frequency trading business, they tell me that there are certain strategies that have a half-life of about 3 days. 3 days. If you're trading at millisecond intervals, 3 days is a lifetime. And so what we're observing in the case of equity market neutral is expected returns that have had this kind of a performance of relatively attractive returns that have gone down systematically, got hit with the financial crisis, and have been struggling to return to profitability. And what you see in the diagram in the back, these bar graphs, is the number of hedge funds in equity market neutrals that have come in and that have left the space. So the green are the new market neutral equity hedge funds, and the red are the ones that have left, that have died. This kind of dynamic is what we see all the time in financial markets, but we don't really talk about it. We seem to think about the system as a physical, stable, stationary machine, when in fact, this is much more like an ecosystem with species that are born, that mature, that die. And this dynamic is what I call the adaptive markets hypothesis. And you can see the rates of return of various different hedge funds in the heat map. These heat maps tell you how much concentration of hedge fund activity there is in the rates of return along this y-axis. And when you take a look at that heat map, you see that the hedge fund industry is not a static industry. It changes very, very rapidly. That's one of the reasons why in my book I call the hedge fund industry the Galapagos Islands of finance, because you can see evolution happening before your very eyes from year to year, from quarter to quarter in this industry. So a new investment paradigm is emerging based on this notion of market adaptation. And the adaptive markets hypothesis is actually a pretty simple idea. Those of you in the industry, I suspect you already know it, because anybody who's ever tried to generate profits from trading, you know that market dynamics can actually shift very rapidly. So the basic idea behind the book is that in the biologist's terminology, nothing makes sense in biology except in the light of evolution. I would paraphrase that to say that nothing makes sense in the hedge fund industry except in the light of the adaptive markets hypothesis. And the basic idea is these 5 principles. Individuals act in their own self-interest. We know that. But they also make mistakes. They come up with heuristics to try to approximate good decision making, but they don't always get it right. And as a result, as they learn and adapt, they change their heuristics. And really, it's the fact that competition and innovation are what generates market dynamics. And by looking at this process of evolution applied to markets, you can get a better understanding of market trends, reversals, and other dynamics. So that's the basic principle of adaptive markets. I want to now just give you a few examples and then wrap up and have plenty of time for questions and answers. So this new investment paradigm starts off by saying that the traditional way of looking at markets, efficient markets hypothesis, that has given us a lot of things that we take for granted, a lot of things that you use in your day-to-day tasks. For example, the long-only constraint. That really came out of the fact that in a relatively stable market, putting your money in a buy and hold strategy actually seems like a pretty good idea. 60-40, stocks and bonds, an asset allocation that allows you to adjust between risky and riskless assets seems like a good idea. Diversifying across stocks and bonds is sufficient for being able to reduce risk. And this whole idea that you should invest in equities in the long run and that you can use passive investment vehicles, all of that came out of the efficient markets hypothesis. This hypothesis is not wrong, but it's incomplete. It doesn't take into account the fact that markets can actually go through periods where a lot of these concepts don't make sense. And the adaptive markets hypothesis really looks at every single one of these implications of efficient markets, questions them, and asks whether or not, when you look at markets from a biological perspective, do you actually get a different set of implications? So I want to talk about one set of implications, which has to do with passive investing, because that's one of the biggest challenges to the hedge fund industry, as well as to all of active investment management. The fact that maybe we should just put all of our money in passive mutual fund vehicles. Vanguard just recently passed the $4 trillion mark. So clearly more and more money is being allocated towards passive investing. So I want to talk a bit about that and how the whole passive investment industry arose. In particular, I want to talk about the evolution of passive investing, and then using the adaptive markets hypothesis, ask the question, where are we going from here? So I want to start by asking the question, what is an index? And this is not a quiz. I'll tell you what my answer is, but then be happy to take questions and comments as well from you. I think we all know that typically what investors and portfolio managers mean by an index is a market cap weighted benchmark of some sort. It's a rule that suggests you focus on a particular sector or a theme, but once you get that sector or theme, you construct a portfolio using market cap weighted averages. Now, it turns out that the origin of this has a really interesting story to it. If you ask the question, who came up with the first index fund, most people will say, oh, Vanguard, Jack Bogle, right? Actually, no, that wasn't the first index fund. In fact, Bogle, in the 1997 graduation speech, gave credit to somebody else. And this is what he said. The basic ideas go back a few years earlier. In 1969 to 71, Wells Fargo Bank had worked from academic models to develop the principles and techniques leading to index investing. John McQuown and William Faust pioneered the effort, which led to the construction of a $6 million index account for the pension fund of Samsonite Corporation. With the strategy based on an equal weighted index of New York Stock Exchange equities, its execution was a nightmare. The strategy was abandoned in 1976, replaced with a market-weighted strategy using the S&P 500. The first such models were accounts run by Wells Fargo for its own pension fund and for Illinois Bell. A nightmare. Does anybody know why it was a nightmare? The portfolio was 100 New York Stock Exchange stocks, equally weighted. Yeah. It was a nightmare because in 1971, if you wanted to construct a portfolio of 100 equal weighted stocks, you have to rebalance that portfolio on a monthly basis. Because if you start out with equal weighting, by equal weighting, we mean $100 for every stock for 100 stocks. If you did that on an equal weighted basis, at the end of the month, it's not equal weighted, right? The stocks that have gone up have higher weight, and the stocks that have gone down have lower weight. So at the end of the month, you have to rebalance. And in 1971, to rebalance a portfolio of 100 stocks on a monthly basis, it took an entire month to do the back office accounting reconciliation. In those days, a spreadsheet was literally a sheet of paper with lines. That was a spreadsheet. And so it was an operational nightmare. And so they abandoned it. And they abandoned it for market-weighted basket. Why? Because when you start off with a market cap-weighted basket, you never have to touch it again. It stays market cap weighted by definition. And unless there are stocks that go in and out of an index, you never have to do anything. This is known as a buy and hold strategy. Buy and hold. And so in the 1970s, passive investing became synonymous with market cap weighting because the technology didn't exist to do the back office reconciliation and accounting for these portfolios. It was a technological constraint that gave us market cap weighting. Now, What if trading were cheaper, faster, and completely automated? Well, if that were the case, then maybe you don't need to have market cap weighting. And that's the point that I want to make right now, which is that what we call an index has been tied up in this technological constraint. But over the course of the last decade, and maybe even longer, we no longer have that constraint. You don't need to have a market cap weighted index for the portfolio to be relatively passively managed. And so I want to propose a new definition of an index. What was it in an index? An index is a portfolio strategy that has three properties. The first property is it's completely transparent, meaning everybody knows exactly how the portfolio weights were constructed. Two, it is investable, meaning that whatever the index, whatever this portfolio strategy is, you can actually get the return of that portfolio. You can deploy $100 million within a 30-day period and actually achieve that return. And finally, three, it's totally systematic, meaning it's rules-based, no discretion, no human judgment. It is totally systematic. To me, that's an index, right? It satisfies what we usually think of as an index, but nowhere does this say market cap weighted. So now I'm going to give you a quiz, all right? And the quiz is this. I'm going to give you some candidates for potential indexes and ask whether they satisfy the definition. So a market cap weighted average, is that an index according to my definition? Yes, exactly, that is. What about an equal weighted average? Is that an index according to my definition? Yeah, of course, it is. What about a target date fund? That's a fund where you've got a glide path for stocks versus bonds, and you adjust the fund's weights as the fund ages and gets closer to its maturity date. That's not equal weighted or value weighted. It's weighted according to this kind of glide path. Is that an index? It's a little harder. It is if you know what the glide path is. Yes, of course. And finally, let me give you some other ones. The FHFA house price index. Is that an index according to my definition? No, it's not investable. You cannot earn the return, which is too bad because it's a very nice index. It looks good, but you can't get that return. What about the typical hedge fund indexes, like the one that I showed you on the previous slide? Is that an index? No. You cannot deploy $100 million and get the hedge fund index. Even the investable indexes, so-called investable indexes, are not unlimited capacity. And so it doesn't satisfy my definition. What about a trend-following futures portfolio? Is that an index? Maybe, yes. Maybe. If it's systematic, it is. What about risk-managed large-cap core portfolio? Is that an index? Again, maybe, if you know exactly how it's managed, how the risk is managed. So these are the gray areas, but that's an opportunity. It gives us the ability to change the way we think about index investing because markets are adapting to these changes. I don't know how many of you are stereophiles, audiophiles. You like listening to music with very expensive stereo equipment. I'm not, but a friend of mine has incredibly expensive equipment. And one of the pieces of equipment he has is this. It's a graphic equalizer, which allows you to adjust the volume across various different frequency bands. Imagine if we did this for portfolios. So what I mean is this. In the 1970s, Jack Bogle and the Wells Fargo crew, they allowed us to change this slider from active to passive management. You didn't have to believe in alpha. You didn't have to believe that your portfolio manager knows how to pick stocks in order to do well in the stock market because you could actually use these market cap weighted benchmarks. But one of the strange things about indexation in the 1970s is that we seem to link risk management to alpha. So the typical passive investment vehicle has no risk management. And so we link the two. So if you want risk management, then you've got to go back and get actively managed portfolios. Why should that be the case? Why should we link risk management with active portfolio management? We shouldn't necessarily be required to do the same. We should be able to break that link. And so imagine one adaptation is to have passive management but active risk management, right? There's no reason why we can't do that because of today's technology. In fact, I would argue that we can engage in what I call full spectrum investments, all the way from hedge funds to index funds. Typically, right now, investors have access to one extreme or the other extreme. And there are many different characteristics of these two: alpha, risk control, liquidity, turnover, credit, currency, Sharpe ratio, maximum drawdown, and skewness. Right now, investors can be up here or they can be down here according to these characteristics. But that means that there's a whole bunch of untapped investment opportunities that now we can adapt our strategies to. So imagine if you can just change these various different characteristics and customize them for each individual investor. In fact, there's this idea in medicine of precision medicine, right? Targeted therapies for each patient. Why can't we have precision indexes targeted for each individual? You know, instead of the Dow Jones 30 or the S&P 500 or the Russell 2000, imagine if we had the Christian Dreyer 30 or the Andrew Lowe 500 or the Bob Merton 2000. If we had indexes for each of us individually focused on our circumstances. And imagine if such portfolios took into account income, expenses, age, health, taxes, and our own individual behaviors. This is what I call really smart beta. It turns out that we have the technology right now to do this. We have the information technology, the software, and the hardware. What we don't have are the algorithms. We don't know how to program the machines to do this yet, but the machines are capable of doing this. And you've heard of robo-advisors, of course, but I can go one beyond robo-advisors. We can actually construct precision indexes for individuals that are so highly tuned to your personal circumstances that they actually do exactly what you need. But what we don't have are the algorithms. So I should tell you that this idea of precision indexes is not new. There was an article written a few years ago titled Personal Indexes. And let me read to you the concluding paragraph of this article. Artificial intelligence and active management are not at odds with indexation, but instead imply a more sophisticated set of indexes and portfolio management policies for the typical investor, something each of us can look forward to perhaps within the next decade. So who was this incredibly prescient writer who wrote this phrase? Well, it was yours truly, and it was published in 2001. So I was off by a little bit. I said the next decade, but actually I wasn't totally off, because it turns out that within that 2001 to 2011 time period, we did develop a number of automated strategies. But we haven't solved the problem completely, and it's because there's a missing piece. And the missing piece is not artificial intelligence. It's the fact that we don't know how to model human behavior. It's not artificial intelligence, it's actually artificial stupidity. That's what one of my graduate students called it. We need to model how people actually behave, as opposed to how we think they should behave. Now, this is a bit mean to call it stupid. It's actually more accurately artificial humanity. It's human behavior. We don't know how to construct an algorithm to capture people's actual behaviors. And I'll give you a couple of examples in a minute of what I mean by that and what the challenge is. It turns out that unless we know how people are actually behaving, we can't construct portfolio strategies that will give them what they really need in light of their human tendencies. So Let me give you an example of those human tendencies. What do investors want? What are they looking for? And I'll give you this by way of an example. I'm going to show you the performance of 4 investment assets. And I'm going to ask you to pick one of the 4, either for yourself or for your clients. And you can only have one of these 4 to invest your assets or your client's assets. I'm not going to tell you what the assets are. I'm not even going to tell you over what time period they span. I'm simply going to show you what the performance is, right? The cumulative growth of $1 invested in each of these 4 assets. So these are the 4. How many of you would choose the green line for your investors or yourself? Wow, okay. How many of you would choose the red line to invest for yourself or your investor? Wow, nobody. How about the blue line? How many people would pick the blue line? Okay, and finally, how many people would pick the black line? Yes, that's the most popular. Well, not surprisingly, you picked the line that has the good trade-off between risk and reward, right? So let me tell you what you picked. So for those of you who, first of all, the time period is from 1990 to 2008. The green line is US Treasury bills, which turns $1 into $2. Not very interesting, and thankfully nobody picked that. Okay. I was told that the Swiss tend to be more conservative, but I'm glad that you're not that conservative. What about the red line? So the green line, if you had picked that, you would have not done very well. What about the red line? The red line is the S&P 500. Most of you did not pick that, and you should think about that because I suspect all of you have an investment in that in some way or shape or form. But if you did pick the S&P 500, you would have done just fine. What about the blue line? I think one of you picked the blue line. The blue line is the single stock Pfizer, a pharmaceutical company that has done very well, but very, very volatile. Now, what about the black line that most of you picked and is the most popular in every audience that I've ever shown this to? The black line is the return to the feeder fund for the Bernie Madoff Ponzi scheme. Now you know how the Madoff Ponzi scheme grew as big as it did. We are all drawn to high Sharpe ratio investments. High return, low risk. That's what investors are looking for, and it's absolutely dangerous because it can bring you into some very, very bad investments. Now, what are investors afraid of? We know what they like. What do they fear? And the answer, not surprisingly, is they're afraid of loss. I don't know how many of you have seen the United States TV show Fear Factor. It's a disgusting program, so I would not recommend it. But it's a program where they actually force people to do some really horrible things. And I want to ask you what the financial fear factor is. What are the horrible things that investors are worried about? And the answer, of course, are these huge drawdowns. So this is the S&P 500 from 1990 to 1994 to 2013. And you can see that from the fourth quarter of 2008 to the first quarter of 2009, if you were fully invested in the S&P 500, you would have lost about half of your wealth in a matter of months. And this is not a new phenomenon, by the way, because if you go back a few years, you have another maximum drawdown to the order of about 44% of your wealth. And so investors, when they're going through this, what do you tell them? What we tell them from the efficient markets perspective is, don't worry about it. It'll be fine. Just focus on the long run. Is that realistic? If you see 20% of your retirement money evaporating, is it realistic for you to say, don't worry about it. I'll just buy and hold and hope for the best? Of course not. Investors are human. They react. And when you see your wealth going down, at some point you're going to say, I can't take it anymore. I'm going to cash. That's human behavior. So when we tell our investors to invest for the long run, we have to make sure that the short run doesn't kill them first. And that's the challenge of human behavior. You know, buying for the long run keeping invested in the long run, it's not bad advice. It's just unrealistic. It doesn't take into account human behavior. You know, one of the issues that the United States had to deal with years ago was teenagers getting pregnant. And the typical advice that you give a teenager to avoid teenage pregnancy is, why don't you wait till after you get married? You know, abstain from sex. That's not bad advice. It's just unrealistic. And it doesn't take into account human behavior. So how do we deal with human behavior? We know that investors want money. We know that they fear these kinds of losses. Fear and greed are incredibly important forces of nature that we need to address in some systematic manner. So the way we deal with that is to acknowledge that investors adapt. And so I want to give you one more example of adaptation and then start wrapping up. Risk perception is adaptive. And the example that I'm going to give you is drawn from an article that was published a long time ago, 1975, by a University of Chicago economist by the name of Sam Peltzman. So Peltzman wrote an article that was incredibly controversial titled "The Effects of Automobile Safety Regulation." It sounds boring, but it launched literally hundreds of other academic studies and many, many careers. And let me tell you what Peltzman did in this article. So at the time, in 1975, the United States government imposed a number of safety regulations for the automobile industry. Things like reinforced bumpers, seatbelts, collapsible steering columns, padded dashboards, and eventually, later on, airbags, crumple zones, and so on. Each of these safety regulations was actually quite expensive. And it was mandated by law that all automobile manufacturers had to install them, which means that they raised the price, and so consumers were forced to buy them. Even consumers that didn't want them, you had to pay for them. And so Peltzman, as a good Chicago economist, said, well, wait a minute, is this adding any value? Are you saving any lives by installing these safety features? So he looked at the number of highway deaths before and after these safety regulations went into effect. And what he found was absolutely shocking. What he found was that there was no effect. No effect at all. Now, that's not exactly accurate. What he found was that once these safety regulations were imposed, there was an effect. The number of deaths went down. And then 2 or 3 years later, it went right back up. And this happened time after time with a number of the different safety regulations. There was one circumstance where the number of deaths went down, but even in that circumstance, what he discovered was the number of automobile occupant deaths went down, but the number of pedestrian deaths increased by the same amount. So what he concluded was that when you made cars safer, people drive faster and more recklessly because they feel safer. And so they can take more risk, and they do. And so, as a result, he claims that the adaptation of driving habits actually eliminated the benefits of safety regulation. His argument was that if you want people to drive safer, the way to do that is not to put safety devices, it's to install sharp knives on the dashboards of the cars. Then people will drive very safely. Now, after this paper was published, there were many controversies that were created, many arguments against this finding. For example, some of the critics said, you know what, you didn't control for driver education. Drivers that are better drivers may not be responding in the same way that drivers that are new. You didn't take into account the kind of driving. For example, are you talking about commuters, or are you talking about people on vacation, or truck drivers? You didn't take into account the locations. Are you talking about the city driving or urban or rural driving? And so study after study after study was done after Peltzman to see whether or not the Peltzman effect, that's what this is called, the Peltzman effect, was real or was it spurious? And there are lots of different conclusions. it wasn't until 2007 when a couple of economists came up with an experimental design for a particular driving setting that controlled for all of these other factors that this controversy was finally resolved. Does anybody know what that setting might be? A setting where you can control for driver skill, income level, the nature of the driving, the context. Excellent. NASCAR. In 2007, these two economists studied what was going on in NASCAR racing, and what they found was something really even more shocking. In NASCAR, when they install a safety device like titanium reinforced struts, the number of deaths actually increases. And you can understand why. This is a real problem for NASCAR. NASCAR is aware of this problem. They're very concerned about it. And it's because if you're trying to win a race, and I tell you that your race car is more safe now, of course you're going to push it to that limit and beyond. This is exactly what we do in the investment context. If I tell you that risk has gone down, what are you going to do? You're going to take more risk, because as an investor, if you're willing to take 8% volatility and the volatility's just gone to 4, well, you're going to double up, right? What if the volatility isn't really 4? What if it only appears to be 4 and you double up on the risk? That's the problem with adaptation. Our risk perception is not the same as risk reality, and yet we adapt to these kinds of changing situations. So artificial humanity is an idea that we want to take into account all of the features of human decision-making in an algorithm, and once we have that algorithm, to design financial products that will help us to deal with these algorithms in a productive manner. So in the case of an index fund that's risk managed, it is perfectly normal and natural and human to pull money out of equities into cash when volatility goes up. When the VIX goes to 40, it is not human to leave it there and not worry about it. You're going to pull money out. That's human nature. But it's also human nature to wait too long before putting it back in. That's where algorithms can come into play. We can help investors by reducing the losses when markets are going down, but we have to put the money back in when the markets start to recover. And so the idea of taking into account human behavior using some kind of formalization, some algorithm of what Christian or I or Bob Merton or any of you will do in certain circumstances, this is the beginning of precision indexes. So let me wrap up by pointing out that, it's been said many times that it takes a theory to beat a theory. The efficient markets hypothesis is a great theory. It's not complete. And to complete it, you need something else. It's very much like the parable of the 5 monks who are blind from birth, and they encounter an elephant for the first time. The monk that grabs the elephant's trunk says the elephant is just like a snake. And the monk that grabs the elephant's leg feels it and says an elephant is just like a tree. They're not wrong, but they don't have the complete picture. So human behavior has pretty much been stable for the last 60,000 years. We are products of the Neolithic Ice Age. The problem is that our environment has changed dramatically. And what works on the plains of the African savanna or on the glaciers of the Swiss Alps, they don't work on the floor of the New York Stock Exchange. And so we need to adapt. And the way to do that is by taking into account evolutionary dynamics. And that's really what the adaptive markets hypothesis tries to do. We want to understand how adaptive each of us is to market conditions. And that's the only way that we're going to be able to address these challenges. This was brought home to me in a very personal way years ago when my younger son was celebrating his 5th birthday and my older son was 10 at the time. So the older one was terribly jealous of the younger one because we had a party for him and it was all about him. And so the older one went to the younger brother and said, Wesley, today you're 5, but I'm 10. I'm twice as old as you. I'm twice as strong as you. I'm twice as smart as you. Basically, I'm just twice as good as you. And it frustrated his younger brother, a lot. For the whole day, he was trying to think about how to respond to his older sibling. And by dinner time, I saw that his face lit up, and he realized how he was going to respond. He said to his older brother, Derek, you're twice as old as me, right? And Derek said, yes, I am. And the younger brother said, that means you're going to die first. So if you understand that, you understand the adaptive markets hypothesis. Thank you very much.
Thank you for this, I think in your terminology, unique presentation. It's not novel or anything like that. It's really
Thank you.
I'm sure there's lots of questions.
Happy to take questions. Yes?
So we know from the behavioral biases that people make lots of mistakes. To me, it looks like you want to cater the biases instead of helping people to overcome the mistakes.
That's right, exactly. But I wouldn't say cater to them. I would say to help them with those mistakes. So for example, again, using the notion of teenage pregnancy, it's a mistake for a teenager to have a child, I think. But if you just forbid them from having any kind of relationship with their peers, that's not realistic. That's not helpful. What would be helpful is to explain to them the various different costs and benefits, and to help them, perhaps birth control or other kinds of counseling. So with investors, I think the same kind of approach is necessary. To tell them you should buy and hold and ignore the losses, that's not realistic. They're not going to ignore them. So if they're not going to ignore them, rather than catering to them, you should say, when the market goes down, you're going to lose. We can reduce those losses to some degree, but if we reduce those losses, you're going to potentially suffer from not being able to have higher returns. How much are you willing to make that trade-off? Let me show you the various different possibilities. And engage in a kind of a counseling where you talk to them about risk management policies for passive investment vehicles. I think that's a more productive approach. It's a more realistic approach. What would be even better is if we had a portfolio strategy that manages an index fund so that the drawdowns are not that extreme. In other words, as you start losing money, you pull money into cash, and as it recovers, you put it back on an automated basis so they never experience a 50% drawdown. That would be ideal, but we haven't done that yet. That portfolio strategy doesn't yet exist, and I think it could exist. Yes?
As we see more, a larger proportion of assets under management moving towards passive indices, I mean, do you have the sense that that will accentuate behavioral biases, dampen behavior, or even just transform them, to the extent that, for example, people who were 20 years ago looking at individual share returns and expressing their behavioral biases through those individual shares, do you expect them to do that now through index ETFs so that there's just a broader, more correlated return structure?
Right. That's a fantastic question, and thank you for bringing up the point. Let me make the point a slightly different way. You've heard of the term wisdom of crowds, the idea that if we aggregate various different opinions, that on average, we're going to get a very accurate estimate of value. That's how the stock market works. In order for the wisdom of crowds to happen, you need two things. First, you need a crowd, right? You need a lot of people. Second, the crowd has to be wise. Now, what does that mean? Wisdom really comes from the fact that people are contributing disparate sources of information. In other words, the crowd is uncorrelated to some degree. Your opinion and your opinion and your opinion are different. And so when I aggregate them, I'm averaging lots of different estimates. If we all think alike, if we all react the same way, the wisdom of crowds turns into the madness of mobs. That's what a stock market crash is. Everybody decides to sell at once. Okay, so now, with that insight, let me ask you, which do you think is going to be a more wise crowd. A crowd where people are engaged in different kinds of investments, or a crowd where we're all literally investing in exactly the same thing. Well, what's happened over the course of the last 10 years is that more and more people are now invested in index funds. And let me give you a consequence of that. When the S&P 500 drops by 20%, now many, many more people will feel that pain at the same time. If we all feel that pain at the same time, and we all decide to sell at the same time, what do you think that'll do to markets? Obviously, market crashes are going to be much deeper, faster, and stronger than before. So that's the downside of indexation. I'm not arguing that indexation is a bad thing. Obviously, it's a wonderful thing because investors now have access to diversified portfolios at very, very low cost. But the consequence of the popularity of index funds is that we now have a shared experience, a crowded trade that could accentuate these kinds of cycles, which is why I'm arguing that personalized indexes, precision indexes, is the way to counteract it. If I have technology that manages your portfolio differently from your portfolio, differently from your portfolio, we won't have the same shared experience. We're likely to have wiser crowds in that context.
I had a question to that, actually. There's a lot of discussion right now at where there will be or might be a balance between actively managed and passively managed assets. Right now, it's, I think, something above 20% of market cap. I think that ecosystem thinking that you're proposing is very much to the point to that. Do you have any idea where that balance might start to take place? Or?
Well, I'm not sure I have a quantitative answer to that, but I can give you a qualitative answer. And the qualitative answer is very much what biologists would say to those of you who are asking. If you take a look at an ecosystem with wolves and sheep, we know that the answer for a balanced ecosystem is not 100% wolves and 0 sheep, or 100% sheep and 0 wolves. You need a balance. And so I don't know whether the balance is 80-20 or 70-30, but I know you need a balance. And so in the market system, we need to have active investors and active managers. We also need to have passive investors and managers. We can't have 100% of one and 0% of the other. My sense is that that balance is actually a moving target that will change as a function of market history. So case in point, right now, the S&P 500, for year to date, it's up, what, about 9% for the year, 9.5% for the year? That's a very, very good return for the S&P 500. And so in that environment, what do you think is going to happen? What's going to happen is investors are going to say, I can pay 2 and 20 for a hedge fund that just gave me a 3% return. Or I can pay nothing and get 9.5%. Which would I do? Let me think. I think I'll take the 9.5%. So more money is going to go to the S&P. At some point, the S&P will be down 10%. And when the S&P is down 10% and hedge funds are up 12, people are going to say, maybe I ought to hedge a little bit and put more money in hedge funds. So that dynamic of active versus passive will change as a function of market history and market experience, and also the sophistication of the investors as well as the technology that exists in the marketplace and innovation. It's a complex ecosystem, so I don't have an answer as to what will happen, but my answer as to how to find what will happen is by looking at the ecosystem as an ecosystem and trying to understand the dynamics between the sheep and the wolves.
Yes. Talk about hedge funds being the Galapagos Island of in the adaptive market theory. Which other asset classes evolve maybe at a human observable speed?
Well, it's typically those asset classes that allow for a fair amount of investor discretion. So, for example, private equity. is a great example. Private equity has evolved very rapidly as well because the assets are large, they use leverage, they're actually able to engage in very, very broad mandates for how to invest. So where the evolution is slowest is in highly regulated investment products where you simply cannot change very rapidly. A mutual fund, for example, it's very difficult to change a mutual fund strategy because, first of all, in order to change a strategy, you have to get the approval of the mutual fund board. And then you have to notify all of the shareholders. And then you have to put that into the prospectus. And then you have to release that over time. So that process can take a year or two to change. A hedge fund can do it in a day. So that's the difference. By looking at the constraints on the investment process, you can get a sense of the wolves versus the sheep and the speed with which they can react.
Maybe one last question from me, if I may. You're also working on how finance can be a force for good in cancer research, for instance. Last time I saw your presentation on Zürich on exactly that topic. Any progress?
Yes, actually, there's quite a lot of progress, and part of that has to do with the Swiss. A couple of years ago when I was here, I gave a talk about using financial modeling, particularly financial engineering, to raise money for cancer drug development. Many of you probably have people, friends and family, that are dealing with cancer, as I did, and I realized pretty early on that cancer patients need a financial economist about as much as a fish needs a 401k plan. You know, we don't have a lot to contribute to the process. But the one thing that we can contribute is to use portfolio theory to improve the financing of drug development. It turns out that drug development is very risky, takes a long time, costs a lot of money, and the probability of success is very low. So if you take a large number of cancer projects and put them into a portfolio, you can actually reduce the risk and increase the number of cancer drugs being approved. So I've been writing about that for the last few years because a number of my friends and family have been dealing with this, and so I have a personal interest in it. And a couple of years ago, I gave a talk here in Zurich as well as in Geneva about this. And just last year, UBS announced an oncology impact fund. They raised $470 million from Middle Eastern and Asian investors within a matter of weeks, focused on early stage cancer drug development. And the portfolio is actually being managed by a Boston-based biotech venture capitalist. And it's the first real portfolio structure of an impact fund that's been launched. And I'm told that there are more that's happening. There are a couple of other companies in the US that I've been involved with that are starting to develop therapies for rare diseases and for other indications using this portfolio structure. So it turns out that finance can actually play a very important role in reducing the cost of capital and increasing funding for drug development. And so I would encourage all of you who have an interest in it, take a look at my website. I've got a number of papers that describe this and would love to get your involvement in that.
So, I think we could stay on discussing for hours, but that will cut into your holiday time. So, hey, let's thank Andrew Lowe for...
Thank you very much. Thank you.